It was just over a decade ago that private equity hit a remarkable milestone. The combined value of companies owned by these elite Wall Street investment firms crossed the $1 trillion mark for the first time. This shadowy, insular world of leveraged buyouts and financial engineering was suddenly too massive to ignore. Critics railed against private equity's platform company model of saddling businesses with mountains of debt and slashing costs to wring out returns. But the money kept pouring in from pensions, endowments and wealthy individuals chasing the outsized profits the top buyout titans promised. Now, as 2023 dawns, the industry finds itself sitting atop a different kind of dubious record, a $3 trillion mountain of companies it owns, but can't seem to profitably unload. Some 28,000 businesses across industries as diverse as software, dermatology, and German beauty retailers are stuck on private equity's books, according to research by the consulting firm Bain & Company. And if you listen closely, you can hear the distinctive sound of worry permeating the marbled hallways of Park Avenue and Greenwich, Connecticut's hedge fund headquarters. It may be another 2 to 3 years before the money starts to come back, Hugh MacArthur, head of Bain's private equity practice, told me grimly. The culprit, he explained, is a dramatic slowdown in deals over the past year as rapidly rising interest rates have made the debt financing that greases leveraged buyouts considerably more expensive. Global buyout volume plunged 44% in 2022 to a 10-year low. This capital crunch strikes at the heart of the private equity business model's circular logic. Firms raise massive funds from investors like pensions and endowments, use that capital plus leverage to acquire companies, then attempt to sell those companies at a profit a few years later to realize gains and return that money to their investors. Rinse and repeat. Except now, with potential buyers retreating, that all-important exit ramp is jammed. The industry's challenges reflect a sharp reversal from the halcyon days of the 2010s, when private equity firms could pass businesses back and forth to each other in ever-rising valuations, minting harrowing tales of fortunes amassed through insularity and financial alchemy. A staggering 47% plunge in the value of companies sold between buyout shops last year reflects a mismatch in pricing expectations, as Bain delicately put it. One alarmed investor I spoke with was more blunt, decrying the practice as indicative of a potential pyramid scheme. MacArthur dismisses such doomsaying, noting that over 40% of the companies awaiting sale are at least 4 years old, meaning their private equity owners may be simply reaching the natural end of their holding period. Half of that $3.2 trillion should be in the window of being sold, he told me. It's going to be a multi-year issue. Still, those are hardly reassuring words for investors growing impatient to receive their capital back. Already, the industry has turned to financial contortions like net asset value loans, essentially borrowing even more using existing companies as collateral, and shifting assets between older and new funds to manufacture liquidity. More skeptical investors like those in the Institutional Limited Partners Association are pushing for greater disclosure around such opaque maneuvers. But the power dynamics of an industry where a handful of brand-name firms like Blackstone, Apollo, and KKR have hoarded the lion's share of investor commitments works against transparency. Bain's data shows just 20 funds accounted for over half the $448 billion raised by buyout shops globally last year, as investors doubled down on known commodities. For firms unable to peddle the "we'll return your money" pitch, the fundraising landscape grew disconcertingly fallow. It was truly a year of haves and have-nots, in Bain's understated phrasing. For the haves like Blackstone's secondaries business, which buys and sells existing stakes in funds, and marquee names able to credibly dangle the "we're good for it" line to investors, 2022 was actually a relative bonanza. The secondaries market nearly doubled in size while Blackstone and others hauled in over $20 billion each to plow into new investments and buy out existing stakeholders in their firms. Private equity's biggest titans even found a way to symbolically hoist themselves back into the sunlight, reviving a very 2021 ritual, the good old-fashioned IPO. Last week, investor CVC Capital Partners unveiled plans to list its Germany-based beauty retailer Douglas on the Frankfurt Stock Exchange at a nifty €6 billion valuation. Fellow buyout behemoth EQT will try a similar trick with dermatology company Galderma, hoping public markets will anoint it with a $20 billion-plus sticker price. Such public listing dreams represent defiant displays of optimism from an industry hunkered down for a prolonged drought. But they also lay bare private equity's endless need to uncork new spigots of liquidity from the general public's pooled capital. After all, there are eventually bills to pay not just for the haves, but their have-not peers too. With the asset-flipping music momentarily stuck on pause, even Wall Street's personal equity gurus may have to resort to going public to keep the party going.